Thanks everyone for joining this webinar. Of course, today we're focused in on the Russia-Ukraine conflict, specifically focusing in on Ukrainian strikes on Russian oil infrastructure and what that could look like, what that means for the oil market and clean product markets as we move into the next few months. My name is Ray Dianson. I am a macroeconomist here at Kpler. I'll be hosting this session. And of course, I am joined by my colleagues, Humayun, who is the lead crude analyst here at Kpler, and Andon, who is our head of oil and tanker research. Again, today we're going to be really focusing in on a number of these key topics around the Ukraine-Russia war. Just to go ahead and set the stage before I hand off to Andon, the war in Ukraine right now looks to be quite attritional. The potential for some kind of peace deal or ceasefire looks to be far off. The interests of both Russia and Ukraine are not very well aligned at the moment. And of course, we have now seen an escalation with Ukraine pushing further into Russia. We've also seen late last month, Vice President Vance floating the potential that Trump was considering allowing Ukraine to use long-range U.S. Tomahawk missiles. So again, the situation right now looks to be potentially escalating around this oil infrastructure question. And so again, my colleagues Humayun and Andon will be covering these topics in detail. Before we move forward, keep in mind, please ask questions as we move through this presentation. We will have a Q&A at the end once Andon and Humayun take you through some slides and presentation. With that being said, Andon, I will hand off to you.
Thanks, Reed, and thanks everyone for joining us today. Let me just share my screen. Here, and yes. Do you all see my screen? I guess, Reed, you're the only one who can answer, or Humayun.
Yeah, I can.
Yeah, all right. Yeah, thanks everyone for joining us. Just a few words before we kick off. Obviously, this is a pretty fluid situation, so we reserve the right to go back and change some of the assumptions on, particularly on the damage done to some of these refineries, because as you understand, information is pretty scarce, coming from different sources. Of course, one side always tries to present the damage as being bigger than it actually is. The other one diminishes it. So we're really making a conscious effort to try to understand the real damage and to collect the actual information about what is and what isn't actually damaged. So without further ado, just putting the stage out for what has been going on recently and where we are right now in terms of Russian refinery capacity being damaged. Maybe some of you have been aware with this map that we've recently shared with the wider Kpler audience, where we outlined the major refineries being damaged by Ukrainian drone strikes, as well as how this fits within the wider Russian highway crude pipeline network. Obviously, the most recent one, and literally the one that we have changed yesterday based on new information coming, is the Kirishi refinery. It has been hit just a few days ago. Apparently, it's going to be at least a month's outage for at least one of the CDUs there. There are a few other things that are worth mentioning here, but for the time being, it's worth highlighting one key thing. It looks like the range and the accuracy of drone strikes has been expanding over the past months, and we are seeing a clear trend of conversion units being targeted multiple times, which again tells us that we're talking about a really well-planned attack on these refineries, not just random hits on CDU towers. So yeah, without further ado, where we are and what's been going on. We have been aware of at least loss of Russian processing capacity in the range of 5 to 550 KBD over September and October. Indeed, the October figure has been 100 KBD lower, as I mentioned just a couple of days ago. But the Kirishi refinery has really tipped the scale, and now October is the month in H2 with the highest rate of damaged capacity. As you can see, there is one thing that's really worth highlighting here when we talk about Russian refineries, and indeed refineries around most countries around the world, save for the US, but Russia in particular. It's worth highlighting that while we lose processing capacity, the brunt of this lost capacity mainly falls on lost middle distillate production. And this is probably the central topic for why most of you are joining us today in this presentation. As you can see, over November and December, we don't believe that these damages will be dealt with really quickly, really swiftly. Have good reason to believe that will be the case. The previous drone attacks have taken months for most of the Russian refineries to fix. On top of that, we are aware that some of them have problems with procuring spare parts and securing additional repair parts for refineries, something that's been becoming a problem in the past. Now, when it comes to maintenance works, that's another topic because it is clearly that the Ukrainian drone strikes have been taking place around the time of peak refinery maintenance. Now, we don't think the Russian refinery operators and Russian refineries in general, integrated companies, have any problem securing maintenance parts. But when it comes to actual units being damaged, it becomes a little bit more difficult to find substitutes for that. But without more details about this question, just one more point I would like to highlight to you. This is with the continuous strikes on conversion units. We have seen a clear trend visible in Russian product exports. We'll get to that in a second. That tells us something. It tells us that the rate of conversion units runs has been falling and at the expense or compensated by simple refinery runs. And what this means is we have seen fuel exports holding up quite well in the face of falling product exports, clean product exports, and a falling gasoline output in general, which is probably the main topic that is currently holding the media space around out there in terms of what the effect is going to be on Russian refinery market. As you can see, total refinery yields in Russia, we project in September and October will fall to multi-year lows, especially because of the lack of or the reduced conversion unit runs, which, as we'll see later, has actually pretty material repercussions for the Russian market. One thing to highlight here, putting things into perspective where Russian refinery runs are right now, we project them at around 4.9 million barrels per day in September, October. September is already over. We're waiting for the final numbers. October, we see little improvement, to be honest. And only in November and December, we see a little bit of a rebound in refinery runs. But again, it's not going to be a rebound back to normal levels, more a rebound back to the levels seen earlier in the year, which, as you can see on the chart, have already been pretty low in historical hindsight. One other thing keep worth mentioning here is the Russian gasoline balance. I mean, of course, it's been pretty difficult in the past years to track Russian gasoline demand in particular. So it is totally possible that in some instances there is some room for revisions to that assumption. But the crux of the matter is this: whatever it is, we are all aware of gasoline shortages in the Russian market right now. We are aware of shortages in various regions around the country. We are aware of a drop in railway shipments of products into Russia, which tells us something, right? It tells us that the market in the country is pretty tight for gasoline, whether it's at -50 or at 0. In my opinion, doesn't really matter because Russia being, the size that the country is and the infrastructure that it operates, a lot of the regions actually have difficulties supplying products from other places. And so even though on paper, you can relatively easily fill this gap by importing more from Belarus. Belarus, by the way, could export up to 40 kbd of gasoline over Q4 based on historical capacity, installed capacity, and demand trends in the country. On paper, this would solve Russia's problems, but again, it's a question of logistics. It's not so much a question of paper barrels where we can just balance the market and everything is fine. We're talking about how would you move these barrels from Belarus all the way into the Far East, for example, which is also the reason why we've been hearing more and more rumors that Chinese independents are discussing the idea of ramping up gasoline production in order to help Russia's Far East gasoline shortages. One way or another, gasoline remains like the Achilles feet of the Russian refinery system. And just as a rule of thumb, whenever refinery runs fall below 4.55 million barrels per day, 4.9, we're already starting to talk about gasoline shortages. And bear in mind, this is not just Russia, because Russia itself is a net exporter, in particular in some regions, into some of the former Soviet countries. Soviet Union countries. So when we talk about Russia being short gasoline or close to break even, it means the wider region, Central Asia plus Russia, is actually pretty short gasoline at this point in time. So yeah, I mean, in terms of where we've been and how this has been translated into the wider market, as you can see, core product exports out of Russia have really taken a sizable hit into September. As we've mentioned and as we've shown before, when we talk about lost capacity in Russia, primary capacity, we're mainly talking about the loss of middle distillate production because of the configurations that most Russian refineries are operating. So while the problem for the domestic market is gasoline, the problem for the export market is gasoil, because half of Russia's gasoil output goes into export markets. And as we've seen over September, a big chunk of this export stream has been affected negatively. We've seen almost 300 kbd of clean product, core product exports drop out of Russia. Again, this is yet another illustration that the relatively minimal drop in fuel exports is also telling us that the Russian refinery system is trying to solve the problem by increasing simple refinery runs. So while you may have seen some news out there about up to 1.5, 2 million barrels per day for Russian refinery capacity being affected, we don't believe this is the actual throughput that is being affected. It is more of a paper capacity. But one way or another, the drop in gasoil is having profound repercussions for the wider market in general. As you can see on the right-hand chart, Turkey has taken a minor hit in exports. The main country that has had a sizable drop in Russian gasoil imports has been Brazil. And as you can see, also the downward trend in Russian gasoil export has been around already for 5 months in a row. It's not something that we believe is not something that is going to just go away anytime soon. Even if there is a little bit of a rebound, we believe this is going to be a structural decline in Russian gasoil barrels, volumes of gasoil being exported. And then talking about gasoil exports, this also had other repercussions for the market. Mainly when it comes to Brazil, this is the main reason why Brazil has been turning to alternative suppliers. As you can see, the share of Mideast, Gulf and Indian barrels into the Brazilian gasoil market has been rising steadily over the past couple of months. Preliminary October data is already showing strong numbers, although this has to be taken with a pretty big pinch of salt. But already the July, August, and September figures are telling us a story that's worth highlighting here, that the drop in Russia is being compensated by pickup in imports from the Middle East and India. We believe if there is no resolution to the drop in Russian gasoil exports, Brazil is going to turn into more alternative barrels. As you can see, one of the solutions has been pulling more US barrels over the past couple of months. There's only so much that this flow can do. On top of that, now that we're in the middle of maintenance season in the US, this also has to come off a little bit. Another one that is probably worth highlighting here is the fact that Turkey will be stemming exports of gasoil in the next couple of months. We've already seen this in the past couple of months, Turkish gasoil exports. I mean, Turkey is not a net gasoil exporter because they still need to import gasoil, particularly from Russia, as we've seen. But they are exporting some gasoil out of their refineries. Now, because of the drop in Russian exports into Turkey, Turkey is retaining more barrels into the domestic market. What this means is essentially lack of Russian gas into the Eastern Med market and the drop in Turkish barrels will eventually start to narrow the gap between Meds and NWE gaso spreads, six spreads, which also means we actually believe that come January things are going to flip into a mild premium for Med gaso. Why? Well, because NW will have a relatively easier time arbing barrels from the USGC, whereas the Met is essentially left with relatively limited amount of additional supplies. Now, of course, when we talk about the wider Atlantic Basin and gaso market, we cannot ignore obviously the biggest net short in the region, which is Europe. As you can see, while Europe is not directly importing from Russia anymore due to sanctions, it is an interesting dynamic that is going on right now in the European gaso imports. As you can see, a lot of the imports over the past couple of weeks have been coming from the US and India in particular. Now, the Indian question is a really interesting one because this probably has to do with the earlier announcement of stronger maintenance works in Europe. The drop, on the other hand, the drop in Middle Eastern barrels is only going to get bigger over October, November, and October and November mainly because of maintenance works, particularly at the winter spec capable capacities in the Middle East. We're talking about Sasref, Satorp, and Mina Al Ahmadi, all going through sizable turnarounds in the next couple of weeks. So Europe is essentially left to compete with Brazil for essentially the same barrels that are coming from the swing regions of Middle East and India West Coast, whereas the US is playing the role of a balancing factor into the wider Atlantic Basin area. Just one thing to keep in mind, the wider context into the Turkish-Brazilian dance with Russian majors is that the seasonality of domestic demand is also pointing towards elevated imports requirements in the next couple of weeks, particularly the front end of the curve right now, because we are already in October and November trading, which also means something else. While we are now in the maintenance season in the Revap refinery in Brazil, that also is going to mean that domestic supply of gas is going to be constrained. On top of that, you have the seasonality of stronger demand now that we've already started the harvesting season in Brazil. So it starts to get really interesting into the Atlantic Basin gas market. Now, the question is, how has the market reacted so far? Now, the real quick answer to this is, well, the swing barrels from both east and west have been kept really to the west. The export incentive to keep barrels to the west of Suez has been pretty, self-explanatory. The spread between east and west has been pretty wide, which also tells you that whoever can and whoever is capable of will be sending more gas barrels into the Atlantic Basin. That's not a one solution fits all though, because we are also seeing USGC to NWE export, ARB windows struggling, have been struggling for a while. Right now, we believe are also struggling again, which again leaves Europe very exposed to fluctuations, particularly on the supply side of the equation from swing suppliers from the Middle East and India in particular. Now, why are we relatively constructive, Gazo, is this part here? Because while you are now in this environment where you would be thinking that, well, now everyone knows how the things look and now the fallout of Russian capacity is already priced in, maintenance season is priced in, so on and so forth. It's not a one solution fits all because, again, like any disruption to supply, any surprise to the upside to US demand or an increased flow from the US into Brazil is going to again put a lid on the export stream from the USGC into NWE, which is going to be supporting the gasol complex into the winter months. And then final few points about the EU's 18 sanction package. Just starting off with the fundamentals here. I mean, we've already lost up to 80 kbd of hydrocracking capacity, not primary capacity in Europe. Hydrocracking capacity, which means gaso-focused capacity, production capacity. So one way or another, even if Europe manages to keep utilization rates elevated, demand struggling because of economic hardships and so on and so forth, it's still going to be in need of pretty sizable import requirements into 2026 and beyond. Now, it's up for debate how Q1 is going to pan out. We currently have it slightly longer than it was last year. That very much depends on how much capacity is going to be utilized in the next couple of months in the phase of attractive refinery margins. Now, that being said, it is very much an open question how the 18th sanction package is going to be implemented, because this will have profound repercussions for European gas oil market, right? Because right now, the way the sanction package is structured is that the responsibility of proving no Russian trace into the production of all derivatives falls into the importer. So this means the importer has to prove that there haven't been any Russian crude molecules involved into the production of this, which also means implication of this is that the traditional ports of Aliaga and Vadinar that have been used as restocking, washing hubs for Russian barrels, crude into products and products into Europe, will no longer be available. At least this is what the regulation stipulates. Additional services will also be denied, which means insurance, brokering, freight arrangements to anyone being involved into moving Russian barrels would also be impacted to some degree. It is totally possible, although this is yet for discussion, that some of the vessels that have historically been involved in moving Russian barrels above the price cap would be denied access to EU ports altogether. Although, again, this is up for discussion because it remains to be seen how the implementation is going to be. And finally, the new price cap being set at $47.6 per barrel, meaning that given the price forecast and the pricing environment that we are in right now, it looks unlikely that it's going to be that the services companies will be allowed to operate with Russian crude anytime soon. And so a few key takeaways for you to continue. The swift return of Russian capacity remains pretty unlikely for the time being, mainly because of the persistent attacks on particular units in these refineries. This is something that will be keeping a firm lid on Russian utilization rates. Gasoline shortages in the domestic market are here to stay, particularly because of logistical constraints, not so much because of paper tightness on the Russian market. Constrained gas supply from the Middle East, turnarounds in Europe and the US will be keeping the gas market supported, coming on top of the loss of Russian barrels into the Atlantic Basin market in general. Brazil and Turkey are already on the lookout for the diversifying gas suppliers beyond Russia. We are already seeing Indian barrels going into Turkey more than before, as well as I said, Indian barrels going into Brazil. It remains to be seen how the 18th sanction package is going to be implemented and what's going to happen. One thing is certain, it's going to add another layer of bullishness into the market because of the uncertainty around the implementation. On top of that, it's unlikely that neither India nor Turkey are going to curb Russian crude buying. So if the regulation sticks to the more stringent way of implementation, we could be talking about 200 to 300 kbd of gas from both countries in search of a new home. And so with that, I thank you very much and pass the baton over to my colleague Humayun for the crude section of this presentation.
Thank you, Andan. Let me share my screen. Put it full screen, just checking if you can see it correctly.
All good, Human.
Yeah, Okay. Cool. So thanks, Andan, for this all section on the downstream side of things. So we'll try to see the impact on the crude market. Try to see what this means in terms of potential bottlenecks in the from the export terminals. What this means in terms of to grades, from Russia, will we see more euros to the market or not? And so, I mean, just to begin with this presentation on crude, there's usually a very strong inverse correlation and relationship between Russian refinery runs and crude exports. So usually when runs go down, exports, on the other way, usually go up almost barrel for barrel. So this left chart shows you that the past 3 years since the beginning of the war, this equation has been true. Whenever we've seen a spike or a spike downwards or upward in runs, we have seen that being impacted into the oil into the crude export in terms of volume. So usually the system adjusts, tries to adjust, quite reactively to the run schedule, to the refining schedule. Now, obviously, this time the outages are not really linked to, I would say, normal technical issues. It's really down to unexpected Ukrainian drone attacks that have really intensified. So it has been taking a bit more time. We'll see this on the next slide. But again, just to finish with this slide to highlight that if we do the calculation of the actual balance, it's nearly perfect, but not quite. But so for example, you look at the right chart. What we are showing here is the difference between the increase in exports and the decrease that you see in runs usually. And so you see that in 2022, for example, what this shows is that exports have increased by an average of about 60,000 barrels per day less than the decrease in runs. But so far, you see that in 2025, despite these outages that we have seen in the domestic refinery sector, so far we have seen about 20 kbd more exports compared to if you assume that the barrels not going to the refineries are going to export or are not going to export. So in this case, so far we've been more or less in line, which again highlights the fact that it has been managed relatively well, actually quite well according to this chart. Now that said, what we have seen is that there has been a bit of a lag and a bit of what we've noticed in terms of temporary constraints when it comes to rebounding exports. So the attacks from Ukraine have really intensified since the middle of September, really. But you see that both in the Baltic Sea. So what you can see on the left chart shows you the exports from the Baltic Sea ports of Primorsk and Ust-Luga on a daily basis, and you can see the 10-day moving average in orange. You can see that that increase has taken a bit of time, since the middle of August. We have seen quite a big jump in the beginning of September. Then there had been a bit of a decrease in the middle of September as both ports of Primorsk and Ust-Luga were targeted. This is the farthest attack from Ukraine over the past 2 months. But you see that it hasn't really, except for 1 or 2 days of disruptions in terms of loadings, we haven't seen loadings really being disrupted for a longer period of time. And actually, if you look at the latest data that we have, there has been quite a big jump over the past few days. And so you look at the 10-day moving average, we're currently edging closer to 2 million barrels per day for both ports. So typically we assume that the actual capacity of these terminals is closer to 2.5 million barrels per day on a on a sustainable basis. So there is still scope for exports to increase if we do continue to see even more outages from the downstream side. Likewise, if you look at the CPC terminal, it's been pretty much the same. We have seen not the terminal itself, but actually the city of Novorossiysk, which is located 5 kilometers from the CPC terminal, being targeted. And that was around the 23rd of September. So you see there's that spike downward around the 25th, which really is a highlight of that. So I think there were loadings were actually stopped for more than 3 days. But in the Baltic Sea, we've also seen bad weather actually over the past few weeks, and especially through the second half of September. That also prevented loadings even before the Ukrainian drone attacks. But you can see that over the past few days, there has been quite a massive pickup in those exports, and actually on the 10-day moving average basis, we're at the highest of the year so far. So this obviously, it's CPC volumes. It includes exports from Kazakhstan, but obviously Russian volumes are also included in there. And just to note that from the other port on the Baltic Sea, on the Black Sea, Shescaris, we have seen a disruption in loadings that have actually been uninterrupted over the past 2 weeks, which suggests that there are ongoing issues at the pipeline linking the Western Siberian fields, the fields around the Volgograd area, to the Black Sea port of Shescaris, and that has actually limited the volumes of Urals available to be exported from the Black Sea. Now, if we take a step backwards and we look at what this means on a monthly basis. So what we have seen again from both ports of Primorsk and Ust-Luga is quite a massive jump actually over the past 4 or 5 weeks. You take September, despite the attacks, there has been an increase of about more than 200 kbd exported from the Baltic Sea ports. Now this is a bit less, I would say, than the actual outages that we are seeing from the refineries, which is year on year more than 400 kbd down. However, if we take the average of month on month, then it's pretty similar. And again, if you remember the chart I was showing on the first slide, it indicates that exports are still jumping as much as we are seeing runs go down. So I mean, we're only the 7th of October. It's still quite early this month, but so far activity suggests that exports are actually continuing quite unabated for the month of October, and we could be in a situation where if it holds at that level, we would be hitting an almost 2-year high in terms of exports from the Baltic Sea. So again, that means more Urals available because the pipelines are linking the Western Siberian fields, which produce Urals to the Baltic seaports. On the other side, if you look at the CPC terminal, in terms of volumes anyway, look at Russian exports, it's relatively low compared to the total volumes exported from the terminal, which are mainly consisting of Kazakh flows. But even there, despite the fact that you've seen bad weather and a few days of loadings interruption through the month of September. September actually has been quite, I would say, almost in line with the past few months. It has been down year on year, but not necessarily down. And the expectation is that we should see quite a major bump into October from the CPC terminal. However, again, just highlighting the fact that there's the fact that we are seeing exports jump really from the third part of September and into the first half of October suggests that in order to reroute those crude flows from the refineries into the export terminals, it is actually a time consuming process, especially that this time it probably wasn't planned by Russia and Transneft. So doing this actually has been taking a bit of time, and that's why there is a bit of a lag. However, again, this increase in flows is something that we should actually be continuing to see over the next few weeks, and that means more Russian crude volumes available into the market. So tightness in products, but in terms of crude, we should actually see that tightness ease, and especially into Asia. Now, if we move into the Asian market, actually, this exports from the eastern ports of Russia. This is what you can see on the left. So the main export, the main blend being exported from the port of Kozmino being really ESPO, Eastern Siberia Pacific Ocean pipeline. You see that there has actually been a large decrease month on month for ESPO. We're down a bit less than 200,000 barrels per day for this grade that you can see in dark blue. This is actually, I would say, these are fields in production that is not being targeted by Ukraine. It's Eastern Siberian production. It's located a lot much farther away from the Volgograd area or even the Primorsk area that has been targeted by Ukraine a few times. So the result of, the explanation behind this drop is actually a combination of two things. First of all, there has been maintenance both in the upstream fields in Eastern Siberia and on the midstream, so on the ESPO pipeline. Usually that maintenance takes place every late August until late September. So even the pipeline flows that have been going to China. So this on the chart we're showing you the seaborne exports, but the pipeline flows going to China we think have also decreased by about 60 kbd for ESPO. So it used to be about 630, and it's now around 580, actually more around 50 kbd decrease. But yeah, that maintenance firstly is part of the reason why we have seen that drop in available cargoes of ESPO. But the second point is also lower demand from China actually. And the fact that you look at the ESPO differentials against Brent, so it's still cheaper than some of the alternatives in terms of light sour, medium sour type of grades that are available for the Chinese refiners, but it's still trading above ICE Brent. Actually, it's still at a premium to ICE Brent in terms of delivered basis into Eastern China. So that may have explained that because of the latest pressures from the US that Anton already discussed about on buyers of Russian crude, they may have been a bit more, I would say, risk averseness from these companies becoming a bit more risk averse in Eastern China. And there's also the fact that you look at some of these main buyers of ESPO grade. You have Yulong, for example, Yulong Petrochemical in the Shandong province. So it's an independent refiner, and what this means is that there is a bit of a tightness in terms of crude import quotas as well into China. So some of the buyers of ESPO may also just be waiting to see to get more clarity on the import quotas before actually buying a bit more. Now that said, the actual flows of Sokol, so another grade exported from Eastern Russia, have been on the increase, and you can see the orange on the left chart, big increase in September. And it may also be due to the product cracks in Asia, which have seen naphtha cracks outperform for most of September compared to other products, partly due to a decrease in Russian naphtha exports into Asia. And so access to those lighter grades from Russia have actually been more I would say sought after than the typical medium sour that these refiners usually get. On top of this, you've had I would say better arbitrage as well from the west of Suez. So you look at even just the export of CPC. So this includes again volumes from Kazakhstan going into Asia. As you can see on the right chart, there has been a big increase, and a lot of those volumes have actually been headed towards China. So again, that Brent Dubai spread that had been weak a few weeks ago has actually pushed some of these barrels into the east, and that also has been weighing on the buying of ESPO. So if you look at the market structure in the crude markets, a typical thing that happened in the past few weeks is that the Asian market has actually been quite supported over the past few months by concerns around supply from Russia. So you look, for example, at the Dubai 3-month spread, which you can see on the left chart and also on the right chart in dark blue. You see that there has been spikes in January. This is exactly when you had, if you remember, the latest Biden sanctions on Russia just before Biden exited the White House. So the market kind of went crazy at the time, thinking that it would really increase the prices of Russian crude going into Asia. In the end, it didn't end up being so. And likewise, since the attacks from Ukraine have intensified in the middle of August, you can see that the Dubai 3-month spread had actually reacted quite positively until the middle of September. And I would say that the recent peak was actually really when you had the attacks on Primorsk and Ust-Luga. But the resilience that we have been seeing on Russian exports, mainly a result of the lag in terms of rerouting those crude flows, is in the end impacting the strength of that structure. And you see the 3-month spread on the Dubai contract actually coming way down, and the past few sessions it has even been going under $1 per barrel. Likewise, you look at the medium sour market, so that length that we're just seeing in Asia, we have been seeing it elsewhere, actually in Europe and in the US as well. And that's due to other reasons. There's the increase in production from the likes of Brazil and Guyana, which have been heading to Europe a lot. There's the resumption of crude flows from northern Iraq that I will touch on. But so the medium sour market looks to kind of correct over the next few weeks, mainly due to that rebound that we are seeing in Russian exports. That said, if you look at the right chart, you can see that the North Sea dated 3-month spread actually has been quite outperforming in the past 2 weeks. And that's really the result of those stronger cracks that we are seeing and incentivizing really refining activity in Europe. So there is a stronger pull for domestic regional grades into Europe. So I was mentioning, that rebound in Russian exports, and actually that is just starting to be seen in the volumes hitting India. So India's behavior has been and still is one of the key, I would say, question marks when it comes to whether how much Russia is going to impact the market. And so you have seen a real increase in threats from the US over the past 3-4 months on buyers of Russian crude. So Andan mentioned that already. But so the question was whether India was actually going to shy away from buying Russian crude. So for most of the summer, it sounded like this potentially could have been the case. Although we think that the reduction in buying from some of the state-owned refiners in India, that you can see in the left chart, you see that in dark blue, that line kind of came down, especially from April, May. Actually, it's actually mainly just linked to the domestic situation in India and monsoon season, curtailing about 10% of refining capacity over the summer until September. And you see that there's been quite a big jump in arrivals into into India over the past 2-3 weeks, and that includes the state-owned refiners. Now, obviously, it's not to say that this didn't have any impact. We have been seeing the spot market for regional crudes, supplied from the Middle East, go kind of crazy in the middle of the summer. So some of these refiners went for more Middle Eastern grades, and you can see that in the middle chart. But I think it's really related to the spread between the cost of buying Urals from Russia and the cost of crude from the Middle East. And you can see that on the right chart. There has been over the past 2-3 months. Actually, if you go back a bit more longer, if you go back to May, June, the price of Urals went as high as the price of Basra medium. So obviously, if it costs as much, importing Urals or Iraqi crude, considering the risk of sanctions, it's still better to obviously to import Middle Eastern crude from Iraq. Basra crude, the delivery time is also a lot shorter. But you see that those threat of sanctions, secondary sanctions, secondary tariffs have been weighing on the price of Urals, and that decrease that we have seen that spread between Urals and Basra medium go to as high as $10 per barrel, even more for comparing the cost of importing Urals versus Arab grades from Saudi Arabia. Therefore, we have seen that rebound in arrivals into India. A quick note to also say that the upcoming sanctions, or actually the sanctions already in place on Nayara energy in India, will most likely mean that Nayara will fully run Russian crude in the future instead of just a bit around 50% in the past. And so we have been seeing, as you can see on the left chart, that increase in the light blue line showing that more and more crude will get into Nayara. As Somo and Aramco have been reducing their supplies to Nayara energy. If we're back in the European market, one of the next main topics to watch is really the impact from the resumption of northern Iraqi crude and whether Turkey will actually reduce its buying of crude from Russia. So if you think again about India in terms of products has actually more alternatives than the European market. And that means that India is less likely to reduce its buying of Russian crude because of the discounts, but also because politically speaking, the top decision makers in India seem to be favoring a more balanced outlook out there between their relationship with Russia, with the US, and with China. So it's not likely that India will reduce its buying of Russian crude. However, when it comes to Turkey, the situation is a bit different, mainly because Turkey's products exports mainly go to the European Union, and replacing that market will become a lot more challenging for Turkish refiners. So one way to play with this is to actually reduce their imports from Russia, and you see that the share of Russian crude in the Turkish market is already on its way down. So currently this year it's around 47%. It used to be almost 60% last year. And actually with the resumption of northern Iraqi crude, so you see the production here on the left from Iraqi Kurdistan, and we have seen the first 2 loadings take place over the past week. So far, they have been heading to Italy, to the Sicily, to the Augusta refinery in Sicily. But it's likely that in the future we see actually that crude from northern Iraq, crude grade, which compares very well with the Urals, medium sour type of crude, go to the Turkish market. Now it's going to be difficult to fully replace the Russian barrels in Turkey. You see that the volumes are around 300 kbd. The exports from northern Iraq are going to be, so far at best, it's going to be 200 kbd. And also likewise, from a political point of view, it is going to be a question whether Erdogan fully gives up on Russia, but probably not. Despite the risk of sanctions, I think there is a balance here to take into account. So maybe Turkey will mainly just reduce its buying of Russian crude rather than completely stop it. And lastly, one of the key questions is what happens if that gap actually widens, if you have less barrels from Russia into Turkey, maybe even into India, can China fill the gap? And I think we've seen some of the answers, through this summer when India bought a bit less Russian crude. You see on the left chart the volumes of Urals going to China. So obviously, most of the Russian grades going to China are Eastern grades. But Urals have seen quite a big jump. both in August, September in terms of loadings heading to India. Now this kind of is going to China. Now this obviously is going to stop with India coming back to the Russian market. But this is a bit of a beginning of an answer. We do believe that another 300 to 500,000 barrels per day of Urals could find its way to China if the Russian market in Turkey and India decreases. But even there, I think there's a limitation to take into account. You look at the right chart, which shows you total imports into China, and you see that the share of Russian crude is already around 20%. So that's the green line that you can see related to the right axis. And China also, I think, will probably be wary not to rely too much on one supplier. So probably that 20 to maximum 23-4% is going to be the top limitation into how much China imports from one supplier, and that is going to also limit the volumes that it is willing to buy from Russia, even if the discount is attractive enough. So that's everything I have on the crude market. And I'm sorry, Reed and Andon, I've been taking quite a long time, but let's open the floor for questions if there are any.
Yeah, no worries, Hamayoun. We're going to do about 5 minutes of questions. I know Andon's been going through some of them live here, but let's just start. Andon, we'll come to you first, just focusing in on, a lot of questions around, what is the refinery infrastructure situation going to look like in Q4? Kind of what's the methodology driving our assumption? And maybe do you have some scenarios that could play out?
Yeah, I mean, methodology is pretty straightforward. So we go by whatever is known as damaged, and then we essentially work with our partners from IIR as well as other sources to assess what units have been damaged and how much time usually it takes for these damages to be dealt with, which means if a refinery is being hit in mid-September, in our balances, it's going to show as a loss of capacity. I mean, if it's closed for, let's say, 5 weeks, 6 weeks, it's going to be lost capacity for a month and a half to 2 months. So this is how our balance is being built and what our assumptions are on that front. We don't go by any scenario about new attacks, because that would underpin us making a call on when and how much new capacity is going to be hit, which is really not our job here. So we don't venture down this path. As for scenarios, I mean, I think what we've seen in the past couple of weeks is that it's becoming relatively easier for drone attacks to reach more specific units and more specific refineries in very particular regions of Russia that cause the most damage to the local logistical system. What I mean by this is the problems that we're seeing in west, the region between the Black Sea and the Caspian Sea in Russia, so south central Russia, so to say, is really targeted because this region is also having problems securing volumes from other regions of Russia.
Got it. Thanks for that, Hamayoun. Andon, and just to come to you, Hamayoun, on that point, what's the theoretical max amount of crude that Russia could be pushing out of the western part of the country? And also, do you kind of have an expectation around what's that balance between lost refinery infrastructure, ability to export, and the potential need to shut in domestic output as well?
Yeah, I'm sorry. I think I kind of missed the second part of your question.
Let's just start with the first part, just max theoretical out of Western Russia for crude.
Yeah, I mean, if you look at the pipeline system, be it the kind of Transneft Baltica pipe, that takes the crude from the Western Siberian from the West Siberian production kind of area. You look at the capacity, and it is above 2 million barrels per day. It's actually closer to 3 million barrels per day. So I think the main I would say the main limitation out there is probably down to how much crude can be exported at the same time in terms of export terminals from both Primorsk and Ust-Luga. And I think out there, we're not too far from the maximum. Right now on a 10-day moving average basis, we're closer to 2 million barrels per day, and I think technically. The nominal capacity is around 2.1, but that has been increased over the past few years. So I think even if it's closer to 2.5, let's say, if they manage to stretch it out, that is probably the maximum that we could see. So it would be another 500 to 600 kbd from the Western ports.
Got it. And kind of to the second part of this question is, do you have any sense of the balance between a decline in refinery run availability in Russia, ability to export crude, and the need to shut in domestic production? Do you see a balance there? And maybe Andon, you can hit this question as well. Do refinery runs drop to such a level where Russia cannot continue to export crude as an offset, and so they need to cut production domestically?
That's let's say that's a distant possibility at this point, because the first step would be that inventories are going to start building, or product on water is going to start building. Probably some barrels are going to head into floating storage or hubs where they will just be stored for a period of time until they find buyers. Theoretically, yes, it is possible. If we reach a point at which they cannot process, they cannot export, they cannot do anything, and we are aware that there is a pretty stark limitation to the Russian crude capacity, storage capacity, which is a legacy of Soviet times. However, it's worth also mentioning that with the drop of Druzhba exports, the trunk pipeline network could be utilized as a storage capacity as well. So it's not a straight answer. To cut a long story short, I wouldn't bet any money on Russia cutting production soon on that.
Got it. That makes sense.
If I could just add on this regarding the pipeline system, the estimates we have is that it's closer to around 120 million barrels being potentially stored just in pipelines. I mean, in terms of capacity, and that's obviously on top of the I think 10 to 15 million barrels that we see in terms of storage tanks capacity.
Got it. Makes sense. All right. I think we'll call it there. We're coming up on the hour. Again, thanks everyone for joining our webinar today. Again, we try to have these on a regular basis to follow the geopolitical events. If you're not a subscriber of Insights, our research offering at Kpler, reach out to sales@kpler.com. We will get you trial access. We cover all of these topics in detail each and every day. With that being said, thanks again for joining, and we'll see you next time. Bye-bye.